Could a storm far away really impact your bank account? It sounds far-fetched, but climate change is now a direct threat to our financial security. Extreme weather isn't just an environmental issue, it's an economic one. Hurricanes, wildfires, and floods can wipe out homes, businesses, and entire communities, leaving banks and insurers with massive losses. When enough banks are hit, the shockwaves can threaten the entire financial system. This isn't a distant scenario. In California, wildfires have made insurance unaffordable, slashing property values. In Asia, rising seas and typhoons are straining local economies and banks. Each disaster is a warning tremor. Central banks now worry these could trigger a major financial earthquake. The systems protecting our savings, banks, investment funds, pensions, were built for a stable climate. That world is gone. The question is no longer if climate change will affect our money, but how prepared we are for the coming financial storms. Understanding this link is the first step to protecting our wealth. The storm isn't coming, it's already here. What is climate risk? It's twofold: physical risk and transition risk. Physical risk is the obvious one: damage from wildfires, floods, and droughts that destroy homes, businesses, and infrastructure, causing huge financial losses. When disasters strike, people and companies can't repay loans, and banks and insurers take the hit. If enough assets are wiped out, the whole financial system feels the strain. Transition risk is subtler. As the world shifts to a greener economy, industries reliant on fossil fuels like oil, gas, and coal face declining profits and stranded assets. Banks and investors exposed to these sectors could see their investments lose value fast. The transition creates winners and losers, and if it happens too quickly, it could trigger a financial crisis. Central banks worry that both types of risk, physical and transition, could destabilize the global economy. The financial world is waking up to the reality that climate change is a risk like no other. It's not just about weather, it's about the future of money itself. Are we ready? Why do central banks care about climate change? Because it threatens financial stability, their core mission. If banks collapse under climate-related losses, panic could spread, freezing the financial system. The 2008 crisis showed how quickly trouble can escalate. Climate change is an even bigger risk. Ignoring it would be like a captain ignoring an iceberg warning. Central banks aren't setting climate policy. They're making sure the financial system can survive the shocks ahead. They're pushing banks to recognize and reduce risky loans and investments tied to climate threats. Their goal: prevent a hidden bubble of risky assets from bursting and causing a deep recession. Central banks are acting as risk managers, not activists, guarding the economy from a storm that's already gathering. The stakes couldn't be higher. Central banks are developing new tools to tackle climate risk, starting with climate stress tests. These financial fire drills simulate disasters, like floods or sudden carbon taxes, to see how banks would cope. The tests reveal hidden vulnerabilities, forcing banks to rethink risky loans and investments. Central banks use the results to push banks to reduce exposure or hold more capital as a buffer. They're also demanding greater transparency, requiring banks to disclose their climate risks. This lets investors and the public see which institutions are taking climate seriously. Some central banks are even adjusting their own investments, favoring green bonds and reducing support for polluting industries. The message is clear. Climate risk now shapes the value and safety of financial assets. The financial system is being rewired for a new climate reality. Not all central banks are moving at the same speed. Europe leads the way, with the European Central Bank and Bank of England running tough climate stress tests and pushing for mandatory risk disclosures. The US Federal Reserve was slower, but it's catching up, running its first climate scenario analysis in 2023. Its approach is still more cautious, focusing on understanding risks before imposing strict rules. In Asia, countries like Singapore and Japan are proactive, issuing detailed guidelines and running industry-wide stress tests. Emerging economies face a tougher balance, managing climate risk while still growing and reducing poverty. This patchwork of rules creates challenges for global banks and risks regulatory loopholes. That's why international cooperation is crucial. Groups like the Network for Greening the Financial System are working to share best practices and build a more consistent global approach. The world's financial defenses are only as strong as their weakest link. Central banks' actions on climate risk affect your savings, investments, and financial choices. Mortgages may get pricier or harder to obtain in high-risk areas. Banks will scrutinize climate vulnerability before lending. Your retirement savings depend on companies adapting to a low-carbon world. Those that don't could lose value. But the green transition also brings new investment opportunities in renewables and clean tech. Greater transparency means you'll soon know how exposed your bank or fund is to climate risk, helping you align your money with your values. Consumer choices can push the financial industry towards sustainability. Ultimately, central banks are working to protect your financial future from climate shocks. A resilient financial system is the foundation for a stable, prosperous society, and your money is part of that future.